Hi, my name's Jamie Douglas, and alongside Gareth Powell, we'd like to reflect on the last financial year for the Polar Capital Global Healthcare Trust, affectionately known as PCGH, but more importantly, why we remain enthused about the opportunity set that lies ahead for us. So I'd just really like to talk about the sector, the opportunity, and then the trust itself. So in terms of the sector, we think the fundamentals remain robust. We're seeing a sector that's innovating, launching dynamic new product cycles. We're seeing multiple sources of durable growth, both in developed markets, but actually perhaps more interestingly in developing markets. And we're also starting to see artificial intelligence have a positive impact in various sleeves within the healthcare ecosystem. And then finally, and really importantly, access and affordability is critical, and we're starting to see companies investing in that thesis and investing in that philosophy. In terms of the opportunity, it's been a tough couple of years for healthcare, but we really started to see a turn towards the end of 2025. We saw a turn in terms of absolute and relative performance. We saw positive ETF inflows for the first time in years. And we also started to see earnings breadth improve, and that was coming off an attractive valuation base. What was the catalyst? There are several, but I think one of the important ones was easing policy fear in the US. The FDA appears to be functioning, but perhaps more importantly, large cap pharmaceutical companies look to broker deals with the US administration to protect themselves from the threat of tariffs. We're also seeing M&A pick up. Impossible to predict the timing and who's involved, obviously, but certainly that's also had something that's had a positive effect on the performance of the healthcare sector. In terms of the PCGH itself, it is an investment trust run by specialists. It does have a large cap bias, and we can invest up to 30% of the assets in what we call a small cap. So that would be a company with a market capitalization less than $10 billion at the time of investment. It's high conviction and it's actively managed. And as we sit here today, it's currently trading at a modest premium to NAV. In terms of the team, we're blessed for two reasons. Firstly, lots of experience, and secondly, stability. As you can see on here, we do have a large number of us, and that's very helpful when it comes to idea generation, covering breadth when it comes to conferences and analyst meetings, but also hopefully extracting the best out of management teams and also managing risk. So as I said, it has been very stable, and Gareth and I continue to run the trust together. So I just nearly now want to review 2025. And this looks at performance. A challenging year in absolute terms, we can't hide from that. But we're pleased to have delivered a strategy that outperformed by nearly 3% over the period under review. Macroeconomic conditions did favour more cyclical sectors, but as I mentioned in the opening remarks, as we exited calendar 2025, we did start to see a pickup in healthcare performance, and we have conviction that that will continue. Digging a little bit deeper into the drivers of performance during full year 2025, pharmaceuticals and healthcare services were the biggest positive drivers. We were underweight pharmaceuticals, but stock selection was positive, particularly with Europe being a best-in-class region for us. In terms of services, the thesis there is very much driven on patient demand, and as with pharmaceuticals, stock selection was the primary driver. Where we were subpar were facilities and technologies, and there were consistencies, i.e. stock selection was challenged, but really it was very much company-specific reasons that drove that relative underperformance. This slide looks at subsector positionings, and you'll see there's been some modest changes, but actually a reasonable level of consistency. So we continue to run with a material underweight in pharmaceuticals and remain positive on biotechnology. In terms of where you're seeing some changes with healthcare supplies, where we've moved from an overweight stance in September 2024 to a modestly underweight stance relative to the benchmark. And also you'll see a difference in healthcare equipment. Whereas as we ended September 2025, we were a lot more constructive on the subsector than we were 12 months previous. This looks at current positioning. You'll see maybe two things of interest. Firstly, we do have north of 30% of the assets in mega caps, so a market cap above $100 billion. But perhaps the most interesting observation on this slide would be the United States, where we are materially underweight relative to the benchmark. It's not really a geographic decision, it's more driven by stock picking, as we simply see better opportunities and better uses of capital outside the US. And with that, I'm going to hand over to Gareth, who's going to talk about 2026 and beyond. Over to you, Gareth.
Thanks, Jamie. So first I'm going to focus on the historical performance for healthcare, and hopefully it can give us some clues about the future. The top chart here shown on this slide is the S&P 500 Healthcare Index, and we show the absolute performance going back to 1989 for healthcare, where returns have been stellar. The bottom chart shows the S&P 500 Healthcare Index relative to the S&P 500, and relative performance has been strong also, but you can see periods where the healthcare sector does really well, like in the 90s and from 2007 to 2015, and then more difficult periods like through the 2000s. But also in more recent times, the performance of healthcare from the beginning of 2023 to the third quarter of last year. This slide tries to look at price performance trends on a much longer term view. And the way we do that, the top graph is that relative performance of healthcare versus the market. The bottom graph is the rolling 5-year relative performance for healthcare. And what we think is interesting here, if you look at the more recent period where the relative performance seems to have stabilised, this very much in our mind mirrors what we saw in 2006 and 2007 before the start of the bull market that ran from 2007 to 2015. So a period of stabilisation and then a better period. So we seem to hopefully be in the throes of stabilisation in terms of price trend, which will hopefully turn into an extended period of outperformance. One interesting way of looking at sentiment around the sector, which we think is really powerful in terms of a contrarian indicator, and that's looking at ETF flows into or out of the sector. So the data we have here goes back to 2013, and you can see that in 2022 we saw really strong flows into healthcare, and that was the last year of significant relative outperformance. And so the ETF flows hit a very high level versus the longer term average. That was flagging as a sell indicator. The sector was overheated. Since that time, that proved to be accurate. We've seen with the significant healthcare underperformance, flows follow that, where we've moved into an extended period of negative flows, which would traditionally be flagging as a buy indicator. They have stayed negative for some time, but again, it ultimately indicated correctly for a relative period of outperformance, and we've seen that obviously in the last few months, and ETF flows have followed that relative performance. An interesting way to look at how sort of oversold healthcare is shown on this slide, which shows healthcare, the weighting of healthcare in the S&P 500. And you can see since 1990 there's been a big range, but if we drill down to more recent times with healthcare having had a strong year in 22, the weighting in this S&P 500 moved back up to 16%, which seems to be roughly sort of the highest level we get to, apart from in 2008-9 where we went above that. From the beginning of 2023, which is when healthcare relative performance turned negative, we've seen a dramatic drop in the weighting of healthcare in the index. In Q3 of 2025, we hit a level below 9%, which is quite astonishing. Since Q3 of last year, healthcare relative performance, we've had a decent bounce, and you can see the weighting in the index has moved higher to 10%. So the driver of the weighting in terms of it moving much lower has been is helpfully shown on the next slide, which focuses on valuation. So this is the long-term relative forward PE for healthcare versus the S&P 500. And you can see again a very wide range. Now, what I'd like to focus on is 2022 through to more recent times. So in 2022, healthcare was very much in vogue because investors were concerned about slower macroeconomics with slower growth, stagflation concerns. So healthcare in that environment does very well, and you can see there was significant multiple expansion where the sector ended up at the end of 22 at a premium to the market. Now, from the beginning of 23, the US economy in particular actually started to surprise with much better growth than expected, and that's really continued for quite some time. In that phase, investors tend to sell areas like healthcare and buy more cyclical areas of the market like industrials, like financials and technology, and that's indeed what we've seen. So that pulled back the sector in terms of its multiple to a 10% discount versus the market, which is quite normal in terms of a sort of macro rotation. However, with the election of President Trump in November 2024, we saw, following that, a number of challenges come in as overhangs on the healthcare sector, which forced investors to flee. And we saw very aggressive, very fast derating the sector to a 30% discount to the market. And that was hit in Q3 of 2025. Now, there are two other occasions shown on this graph in terms of the history here of when we've hit a 30% discount. If you actually go back, the chart only runs to 95. If you actually go back to 1990, there's one other occasion then in 92 and 93. Those previous occasions have proved to be excellent entry points for the sector. And again, 30% discount to the market. And you've seen healthcare rally again just recently from Q3. And the discount has moved back up to a 20% discount, but still a long way to go to get back to it, even in line with the market. So we're optimistic that things are turning here. Valuation still remains very attractive. The driver of the uplift in valuation is those overhangs that I mentioned. They're lifting now, and we're hopeful that'll entice investors back into the sector, and they'll focus on fundamentals rather than policy concerns in the US. One sort of shorter term focus slide. So what this graph shows is the average relative performance of healthcare versus the market in each year of a presidential cycle. So the data started from 1973 and basically average out to most recent times. And you can see that this year two tends to be a very strong performance year for healthcare stocks versus the market. Now, the driver of this is the midterm elections, and in 2026, in November, we'll have the midterm elections again in the US. So the healthcare sector seems to discount a better policy environment post the midterm elections, and the policy environment tends to be less of a risk for healthcare because you tend to see reversion against the incumbent at the midterm elections, and so that reduces fears of significant policy change in the last 2 years of a presidential cycle. This slide shows the long-term growth areas that we see as most important for healthcare. So we've highlighted these 6 themes many times, and they continue to be the most important themes for healthcare, and I'll just simply list them off. Healthcare delivery disruption, innovation, consolidation, emerging markets, outsourcing, and prevention. We view these as the most critical in terms of delivering growth for healthcare over the next 5 to 10 years plus. On a shorter term basis, there can be other drivers, or longer term drivers can be important on a shorter term basis as well. So thinking 1 to 3 years, here we highlight 3 important drivers for us: access and affordability, emerging markets, which is obviously a very long-term theme as well, and artificial intelligence. So just briefly, access and affordability, what's key here for us? We have a large exposure to companies that sell generics, so cheaper products that are launched when patent protection runs out. This is going to be really important over the next several years because there's going to be a vast array of products that will lose patent protection and a significant opportunity for generic companies to launch cheaper drugs, which globally will improve access and affordability. So that's a really important theme over the next few years. Emerging markets, Healthcare spend is incredibly low versus developed markets. We see a really long-term growth opportunity, but there's also a short-term opportunity to invest. We're seeing countries like China attempt to improve access to healthcare with efforts on private insurance and also government programs to improve access to healthcare. That should be a really important driver for growth of the industry, and so there's a shorter-term opportunity there. And then last to finish, AI. We think this is going to be really important for healthcare with the opportunity to automate. In the shorter term, we're seeing this become real in terms of the use of AI for reading scans of patients. We're seeing that now. And also things like doctors wearing devices that can record and produce reports through AI when they're going around seeing patients in the hospitals, improving efficiency. So already seeing this at work. Longer term, we see opportunities in actual product development on the drug side and the medical device side, the use of AI to speed development, lower cost, and hopefully improve success rates, which could be really powerful. So in the short to mid-term, really excited about these three drivers for the healthcare sector. So just to finish, the outlook for healthcare in 2026 and beyond. We think the sector is a really attractive level here after being through a difficult period. The opportunity with valuation discount and the fundamental opportunity with new product cycles. We see the potential for strong revenue and earnings growth. And the three shorter mid-term drivers, access and affordability, emerging markets, and AI as key over the next 1 to 3 years, and the longer-term drivers over the next 5 to 10. Why PCGH? The trust gives you broad exposure to healthcare, global, large cap bias with opportunity to also invest in smaller, exciting companies. We have a process that is high conviction. It's an active strategy. We think it's well set up to invest in healthcare stocks and overall hopefully deliver strong performance like we have across different healthcare funds that we run at Powell in the years gone by. We have a very experienced team, which we think is absolutely crucial, focused on all the different areas in healthcare, including the key themes. Healthcare is a diverse, complex and dynamic sector. We think it's the best sector for an active management strategy. We will endeavour to deliver outperformance with PCGH. Thank you for listening. Any questions for the managers or the board, please email cosec@polarcapital.co.uk with the subject PCGH-AGM. Thank you very much.